Welcome to the RiskWire Podcast on the House. So June is National Homeownership Month. It celebrates and highlights the importance of homeownership. And I thought this was a good time to talk about homeownership in the US. I specifically wanted to explore the question, has the American dream of homeownership become too expensive? Has it become a luxury? My name is Reena Agrawal, and I am a senior research economist at Veros Real Estate Solutions. So for generations, owning a home was viewed as one of the defining milestones of adulthood. You finished school, found a job, started a family, and eventually bought a home. It wasn't always easy, but it was considered attainable for a large share of middle-class households. Today, that assumption is being challenged. Across the country, many Americans with stable jobs, good incomes, and strong credit scores are finding themselves unable to purchase a home. The first-time buyer is getting older, down payments are getting larger, and more buyers are relying on family assistance. According to data from the National Association of Realtors, 22% of first-time home buyers used gifts or loans from family and friends for down payments. And in many markets, homeownership feels less like a normal life milestone and more like an exclusive achievement. So today, we are going to explore whether homeownership is slowly transforming from a middle-class rite of passage into something that perhaps resembles a luxury good. So in economics, a luxury good is something people buy more of as they become wealthier, and it is typically a non-essential good. Housing or shelter itself is a necessity, but for many Americans, owning a house increasingly feels like a luxury. Most conversations these days about housing and affordability focus on mortgage rates and home prices. Rates certainly matter, prices certainly matter, but they are not the entire story. Besides needing sufficient income to qualify for a mortgage, first-time buyers need enough savings for a down payment, they need cash for closing costs, they need enough financial security to take on what is likely the largest financial commitment of their lives, especially in today's uncertain economic environment. And they must do all of this while competing in a market where home prices have risen much faster than incomes. Home prices have risen 53% since 2019. Median household incomes up 24% over the same period. So we have talked about this before in previous podcasts. All generations have faced similar financial burdens, but it seems particularly tough for first-time buyers today to achieve the goal of homeownership. Many households who would have purchased homes in previous decades are now remaining renters much longer than expected. And one of the clearest indicators of this shift is the age of the first-time home buyer. In 2010, the age of the first-time home buyer was 30 years. In 2025, the age of the first-time home buyer has increased to 40 years. Think about what that means. People are not delaying home ownership by a year or two. Many are delaying it by nearly a decade, and that has important implications. A person who purchases a home at age 28 has far more time to build equity than someone who purchases that first home at the age of 38. Another indicator that first-time buyers are finding home ownership difficult to achieve is the share of first-time buyers. This has reduced by half from 40% in 2010 to just 21% in 2025. And this delay in home ownership not only affects wealth accumulation, but also can impact retirement planning, family formation, and financial security. But why is this happening? One reason is that housing affordability has deteriorated significantly. Another factor, perhaps, is the growing role of wealth. Historically, income was the primary determinant of homeownership. If you earned enough money, saved diligently, and managed your finances responsibly, homeownership was generally attainable. Today, wealth may be gaining importance. Many first-time buyers are relying on financial assistance from family members. Parents are helping with down payments. Grandparents are contributing to closing costs. Inheritance is playing a larger role. In some markets, in fact, family wealth can be the difference between becoming a homeowner and remaining a renter. So then, that distinction matters. Households that have access to family wealth versus households that do not. Two people can earn identical salaries and have identical credit scores, yet the housing outcomes may be very different depending on whether they receive financial support from family. Home ownership has long been one of the primary ways Americans build wealth. And if access to home ownership becomes increasingly restricted, access to wealth building opportunities also becomes restricted. And this is where the discussion becomes larger than housing. We are no longer simply talking about real estate. We are also talking about economic mobility. If fewer households can enter the market, the benefits of housing appreciation become concentrated among those who own. Also, when discussing housing affordability, a key factor is the disappearance of the starter home. For decades, the housing ladder was relatively straightforward. A young household would purchase a modest home as their first property. After building equity for several years, that household might upgrade to a larger home as their income increased and the family grew. Eventually, they might downsize later in life. The key to this system was the existence of an affordable entry point. Today, that entry point is becoming increasingly difficult to find. And the reason is simple. America is building fewer homes that are affordable to first-time buyers. Many communities are seeing fewer affordable homes being built and more mid-range and luxury properties entering the market. But there is another force making the situation even more complicated. And that force is the lock-in effect. It has become one of the defining characteristics of today's housing market. During 2020 and 2021, millions of homeowners refinanced or purchased homes when mortgage rates were extraordinarily low. Many secured rates below 4%. And this has had enormous implications for housing supply because existing homeowners are one of the largest sources of housing supply. So the result of the lock-in effect is a reduction in available supply, and when supply remains limited, prices remain elevated. And this lock-in effect may be the most important housing story of the past several years. What we are seeing is that there are no longer one set of housing market conditions affecting everyone equally. Instead, there appear to be two very different housing markets operating simultaneously. So when I'm talking about two markets, the first housing market belongs to existing homeowners, and the second housing market belongs to first-time potential buyers. For existing homeowners, many have substantial home equity. Homeowners collectively hold more than $34 trillion in home equity right now. And the average mortgage holder now owns $315,000 in home equity. 40% of homeowners own their homes outright. So that is a significant amount in home equity. For prospective first-time buyers, however, the experience is very different. In many cases, today's buyers are competing against homeowners who accumulated wealth during one of the strongest periods of home appreciation we have seen in the US housing market. And this creates an increasingly unequal playing field. One group benefits from rising home values, while the other group struggles to gain access to those very same benefits. And this is where our original question becomes especially relevant. Luxury goods are not simply defined by high prices. They are often characterized by limited access. They are available to some people, but increasingly unavailable to many others. Homeownership has been one of the defining characteristics of America's middle class. That accessibility appears to be declining, not because people suddenly stopped wanting homes, but because the financial barriers to entry have become higher. And it raises an important question. If fewer households can enter the housing market, what happens to wealth creation? What happens to economic mobility? And what happens to the American dream itself? So let's take a step back from mortgage rates, inventory levels, and housing affordability for a moment. When economists talk about wealth inequality, one of the first things they examine is homeownership. The reason is simple. A home is often the largest asset a household will ever own. Data shows that the median wealth of homeowners is 40 times that of renters. Homeowners' wealth is around $400,000 versus just a meager $10,400 for renters. And why does this happen? As homeowners make monthly mortgage payments, a portion of those payments goes toward building equity. At the same time, if home values appreciate, that equity can grow even further. So this process has allowed millions of families to accumulate wealth without necessarily being investment experts. So in a way, home ownership serves as a bridge between income and wealth. But what happens when fewer households can cross that bridge? Consider two hypothetical families. Family A purchases a home at age 30. Family B remains a renter until age 45 because they cannot afford to buy earlier. So over the next 15 years, Family A gradually builds equity through mortgage payments and home appreciation. Family B pays rent during that same period. At age 45, both families may have similar incomes, but their balance sheets could look dramatically different. One family has accumulated housing wealth, the other has not. And when entry into home ownership is delayed, wealth accumulation is delayed as well. And increasingly, that delay is becoming common. So the housing market is creating a wealth divide between owners and non-owners. Think about what happened since the pandemic. Home prices rose dramatically over much of the country. For homeowners, that appreciation translated into increased wealth. For renters hoping to buy, however, rising prices made homeownership even more difficult to achieve. Basically, that same event created very different outcomes for different groups. Here is some interesting data. Right now, homeowners collectively hold more than $34 trillion in home equity. So that is a huge amount. And what is making this issue even more complex is that family resources may be playing a larger role in the homeownership process. This means that access to homeownership is becoming partially dependent upon access to wealth that was accumulated by previous generations. And this might create a feedback loop. Families that have wealth, they help future generations purchase homes. Those future generations then build additional wealth through home ownership. And over time, those differences can compound. So if the path to home ownership narrows, broader economic consequences may follow. And some of those consequences may be that marriage rates have declined, the age of first-time home buyers has increased, household formation has slowed in some demographics, Young adults are remaining with parents longer. However, I do want to say at this point that I'm not sure if delayed marriages or delayed home ownership are due to inability to purchase a home, or is it because people are spending more years in college, especially women are staying in college longer and are spending more time settling in their careers? Also, some people may be choosing to have that geographic mobility that renting allows, but homeownership does not. But we are seeing those trends, those demographic trends in the country. My aim here was not to paint a gloomy picture about the path to homeownership, but talk about how it is feeling out of reach for some folks. That path to owning a home has not disappeared. It is very much there. 65% of households own homes, but this number has declined from 69% in 2005. Millions of Americans continue to buy homes every year, but the path appears to be narrowing for some households. And is this trend permanent? Or is there a realistic path toward making home ownership broadly attainable again? The answer is, it depends on which aspect of the housing market we are talking about. Home ownership has not become a luxury good for everyone. Millions of households still own homes. Millions more will buy homes in the coming years. The housing market has not closed its doors completely, but for many first-time potential home buyers, especially younger households and middle-income families who live in high-cost markets, home ownership increasingly behaves like a luxury good. So in the past, affordability challenges often improved when mortgage rates fell or when home prices softened. Today, lower rates alone may not be enough. If mortgage rates do decline, monthly payments may improve, but lower rates can also bring back more buyers back into the market. And if supply remains limited, that additional demand can put upward pressure on prices again. So that is why the solution cannot be only about mortgage rates. The issue is deeper. The issue is supply. The market needs more homes, and especially more homes at lower and middle price points. This is where the starter home becomes so important. And that is because land remains expensive, construction labor remains constrained, material costs remain elevated, local zoning and permitting processes remain difficult in many communities. And builders still have strong financial incentives to keep building larger, higher-priced homes. So there is a need for streamlined permitting that can affect the type and quality of housing that gets built, but those changes are often difficult. Many existing homeowners support affordability in theory, but oppose denser housing in practice. Communities often want home prices to be affordable for the next generation, but they also want to preserve neighborhood character. They want to limit traffic, protect property values, and avoid rapid change. Those goals are not always compatible. Another thing is geography matters more than ever. The national housing market headlines hide regional variations. There are many markets where 40 to 50% of listings are considered affordable, and competition is manageable in these markets. So if you're stuck waiting in a coastal market, ask yourself, is the zip code part of your actual life plan, or are you willing to move to attain home ownership? There is also the question of demographics. Millennials are now in their prime home buying years. Gen Z is beginning to enter the market. At the same time, many baby boomers are choosing to age in place rather than downsize. For years, there was an assumption that aging baby boomers would eventually release a large amount of housing supply into the market. That will only happen gradually. Another potential shift is the role of new technology and construction methods. Factory-built housing, modular construction, more efficient building techniques, They could eventually reduce costs and speed up delivery, but these are not likely to solve affordability overnight. Also, the lock-in effect is loosening, but only very slowly. So housing affordability is not constrained by one variable. It is constrained by many factors. Mortgage rates matter, home prices matter, supply matters, incomes matter, demographics matter, policy matters, family wealth matters. And this brings us back to the central question of the episode. Is homeownership becoming a luxury good? My answer would be this. Homeownership is not yet a luxury good in the traditional sense. It is still a broad market. It is still a goal for millions of families, and it is still attainable in many parts of the country. But the path to homeownership is becoming more exclusive. It increasingly favors households with higher incomes, stronger balance sheets, existing wealth, family support, or the ability to buy in lower cost markets. The risk is not that no one can buy homes, but it is that home ownership itself may be moving out of reach for the very households it once helped lift up. Thank you for listening, and I will see you next time.